I started just going over an annual report. I know you guys have probably done this in your other classes, but just go just to do it again. We'll go over an annual report. This is General Electric, could be any company though. We're gonna finish the chapter 12 handout, which should take, I don't know, 5 minutes, maybe 10 minutes. And then 13 and 16, we'll hopefully get on today. And I think what I might do is send out the test. I think I'm gonna include all chapter 11, 12, and 13, 12, 13, and 16 on the same test. They're all kind of like, they're all small chapters. So, and that way we'd only have one thing to do. And you know, I'll pick out one or two things from each chapter. Yeah. So anyway, so that's what we're going to do tonight. So let's get started here. Okay, so annual report. So all companies need to are required to put out an annual report. The annual report can be read by anybody. It contains information about the company. Important for us is it contains the financial statements and the audit report that must go with the financial statements. So this annual report, they're usually between, I don't know, 60 pages and maybe 200 pages. This just depends on the company. But between 60 and 200 pages, and it has a lot of background on the company and all that kind of stuff. And then for our purposes, around the middle of them, whatever the middle is, they have the financial statements and usually the auditor report along with it. Okay, so I gotta move some stuff here. Okay. So if you go to bottom, you can see all the people that are, and by the way, these are made at a very high level. So if you go about halfway down, maybe a little more in this case, you'll find the financial statements. And here's what we're looking for, the audit reports. Looks like it's on page 52. Now the audit reports are a little bit different nowadays in that they start out with the opinion first. The opinion used to be at the end, and you know, everyone would open up the report and they'd look at the end, you know, because that's what you're looking for. So anyway, they start out with the opinion first, and then they kind of talk about it later on. And there's a lot of things that are put in here that are what they call oh, I'm drawing a blank on it. Critical audit matters. So critical audit matter. You'll also hear them call it a CAM, but the critical audit, and there'll be some stuff in there that they'll go through. Here's an opinion on the internal control. So there's two opinions, a publicly traded company. Opinion on the consolidated financial statements. That's just all of them together. They usually don't put, they usually have it, it's on a consolidated. And anyway, here comes the financial statements. These are all in what, millions? Millions. So they had a bad year. They lost $6 billion. Wow, they had quite a roller coaster. Yeah, what are the dates on here? So 2019, they had a $5 billion loss. Last year, they had a $5 billion gain income, and this year they have a $6 billion loss. So anyway, so this is, are the financial statements, and that's what the whole point of doing getting your CPA license is so that you can sign off on these audit reports. Now, one of the things that we're going to talk about in the audit report, and the reason I'm kind of getting at this is later on we'll come up with, is that what do you do if information in the annual report doesn't match up with the financial statements? Okay, so what happens if there's a mismatch between them? But that's an audit report, financial statements in the audit report for General Electric. And again, all publicly traded companies have to put that out. Some companies are more involved than others. General Electric is probably more involved than most because it has electronics and engines for military contracts and all kinds of stuff. So they got quite a bit going on there. Okay, let's jump into and finish up the Chapter 12 handout. I think we're on the last page of it. And we talked a little bit about this already. Auditor's responsibility for observing the physical audit. And remember, we talked about this last time, that there are actually two parts to inventory. There's the count, and then there's the pricing. So it's kind of like two things you got to look at: the counting of it, and then the pricing of it. So we're talking about the physical inventory, though. This is the counting of it. So auditor's responsibility to observe the physical inventory, inspect the inventory, determine its existence and condition, and make test counts. And I think we talked about this one. Okay, so while we are, okay. So while we're mainly looking at the count of the inventory, we also do pay attention to the condition of it, because it could show the condition, even though that item is there, if the condition of it is such that you observe it, that it's unsaleable, or that there's a problem with it, or that maybe it's been there for a long time. If you have especially if you're doing this inventory over and over again, known as a U.S. Steel, that we had coils of steel that were from the previous year, they haven't been sold, that there might be some kind of a problem with it. So you're always, even though you're doing the counts, you're also aware of things that may have to do with the pricing of it. Observe compliant with management's instructions. So you'll get an the operational employees, those that are counting the inventory. Instructions. Obtain evidence about the reliability of the counts procedures, and that is basically, for the most part, this is going to be test counts. Okay. Control of inventory count tags. Inventory count tag serially numbered. Which, by the way, always cracks me up. They talk about, oh, like invoices have to be serially numbered, like, like they be randomly numbered or something. But they all say serially. Oh, no, not numbered, serially numbered. So, okay. It's not just going to be randomly numbered. The account report and the purpose of the account sheets. And that nothing was counted twice. Oops. So each area will have one count sheet, pre-numbered. Everything will be counted once, nothing will be counted twice. So that's the whole idea behind the count sheets. Count sheets are count tags, whatever you want to call them. What's in there? Okay. So we will be done with that. And let's go on to something different. Let's go to chapter 13, property, plant, and equipment. Okay, property, plant, and equipment. Okay, which will take longer to audit?
Probably inventory.
Yeah, inventory will take longer to audit. That's the question. Yeah, the inventory. You get a lot more of them. Hundreds of them. There's inventory is coming in and going out at all the time. It's going in, and so every day inventory is sold. Every day inventory is purchased. It's a moving target. It's a lot harder to audit inventory. Equipment. Maybe you get something. You will get new equipment in during the year, but it's not nearly as fast as, say, inventory. And usually you bring something in and it's going to sit there for 5 years or however long it takes. There's also less risk for property, plant, and equipment. And the less risk comes from the cutoff. you do, for instance, you do depreciation by the month. And so if you have something that is that should be on the books in December and it's not put on until January, there's not going to be any depreciation expense either way. So even if something is left off the books, it's not going to affect the income. And as auditors, we're very keen on income, that the income be the number, because companies from year to year will all say, what was the income, what were the earnings for it, all that kind of stuff. So cutoffs aren't as important for property, plant, and equipment. Do you still do them? Yeah, you still do them, but it doesn't have nearly the impact on the financial statements that say inventory. One day of inventory can really skew the numbers, whereas one day of property, plant, and equipment, probably not. Okay, so equipment is usually a much bigger dollar amounts per unit, and a lot of times they'll stick around for years and years and years. Okay, initial audit. They will usually have a complete. Inventory of property, plant, and equipment. So the initial audit, usually you'll have a complete inventory of property, plant, and equipment. You'll go through everything, and that'll be kind of your starting point. That is one of the reasons why the initial audit might cost a little more, because we're going to find out that later on, because inventory doesn't, because equipment doesn't really usually turn over that much. We're going to find out that later on, we don't actually do a complete audit of property, plant, and equipment, unless there's a problem with it. If they have a serious problem with the initial time, maybe you'll do it next year just to make sure everything's okay. But generally speaking, you do it on the initial appointment, and then repeat engagements. Hey, what's the? Repeat engagements. Yeah, you usually do it every 3 to 5 years. Tabs there. Okay. In between complete inventories, only additions and retirements are audited. So we're going to see, so we did a complete inventory last year, let's say. This year, we're just going to see, okay, what was added to it, what was retired, and audit those things rather than do a complete inventory. So this is different than, inventory for, I should say merchandise inventory here. So this inventory is not the merchandise inventory. And in between complete inventories, additions and retirements. So if we already looked at all the property, plant, and equipment last year, this year we're going to say, okay, what was added and what was retired? So those are the kind of the things that we're going to look at for property, plant, and equipment. And again, the reason being, they usually not that much happens. If there was a flurry of activity, you know, they open up a new plant, did all the stuff come in, maybe we would do a complete one. But generally speaking, unless something as strange has happened, we'll say, okay, for the next few years here, we'll just do, you know, additions and retirements and back into the number. Okay, opinion summary of analysis of changes in property, plant, and equipment owned and reconcile the ledgers. Okay, so you're going to look at the pluses and minuses of the inventory. Okay, about additions to property, plant, and equipment during the year. So additions, so this is stuff that they've purchased. Now, additions are usually easier than retirements to do because additions have a whole bunch of stuff of paperwork. Usually, you order a machine, you know, okay, there's a purchase order. There may be a work order to get the, you know, to bring the thing in and to get it up operating. There could be there's going to be shipping documents. There's going to be invoices. There's going to be a bunch of documents to vouch for any equipment that was brought in. So this would be have there's retained report be something that, you know, obviously was brought in. There's a purchase order to match up against it, vendor invoices, work orders possibly. You know, anything that, you know, it has to do with getting that equipment in there, you can vouch for those. All right. Make a physical inspection of major acquisitions of plant and equipment. So once you vouch that they have these additions, you get all this paperwork. Now you want to go see this thing. And so you will go to the factory floor and you match up the, they should have asset tags on them usually. And if you're working this kind of environment, if you're an auditor, you know, they'll have, trying to find an asset that we can, Okay, it's not a very good asset. But, you know, if you were looking at some piece of equipment, let's pretend like this is a drill press or something. There should be somewhere on it, there should be a tag, you know, tag 5723 or whatever. So then you say, okay, the addition, it should have that tag 5723. That'll identify the asset. You can go check and make sure that asset's there. When you're on the floor, you're also going to do a test backwards so that if you find a tag on something and say, okay, well, let's go take a look and see if that's on the books. But, you know, a new asset, we get this new drill press. It's not a very good drill press, by the way. But anyway, you get this new drill press in or whatever, then you're going to go look for the tag, and that tag should match up to it. As accountants, that's what they should be doing. I had a kind of a crazy problem with an audit that we're in a factory, and there's literally like a $3 million valve on the books. So a valve, like a $3 million valve on the books. Well, that's got my interest. I want to see what a $3 million valve looks like, because they have, these different stuff going around the factory. Though it was an engine plant. It was actually the engine plant in Melrose Park for Navistar. But anyway, so I go out in the factory and I find this thing. So I find this thing. It's got the asset tag on it, and I'm looking, and it looks like any other valve. It's just a valve. And as I'm looking around, I see like a bunch of other valves that are just like it that don't have any tags on them. What they did, they're doing this big project. They got lazy. They put a tag on the first thing that came in, which was the valve. And then all the rest of the costs for this entire thing were put on this one valve. And the problem you have with that is we'd actually taken some stuff out that was in that original group. That they never recorded because the one valve was still there. So there was actually, a fairly sizable retirement that was never picked up. And by the way, this was an audit that I told you I was usually inventory guy. I do the merchandise stuff, but the lead auditor, a really good guy, he was kind of like my mentor. He was there previous audits, and there's a problem with the inventory, so he wanted to do the merchandise inventory, and I had to do fixed assets. So I was like, woohoo! Because fixed assets, they don't, they come in, thunk, sit there for 5 years, thunk, yeah. So anyway, but it ended up being a lot more work than I thought. But anyway, they should have asset tags on them. Okay, this one is not as obvious. Major repairs to equipment should be capitalized if they one or two, so major repairs to equipment should be capitalized if they increase the lifespan or if they increase the capacity of the asset. Now, normally repairs are just expense. So, okay, we have a pickup truck and we get the brakes worked on, we expense it. That's a normal expense. We get new tires for it, that's a normal expense. Okay, however, suppose that we have the engine completely overhauled. Well, that's probably going to increase the life of the asset. So we're probably gonna put the cost of that overhaul, that engine, into the asset and then depreciate it over the rest of its life, because it's probably gonna have a longer life now. So if they're normal repairs, they're just expensed. But if they increase the life of the asset or the capacity, so suppose we take the pickup truck, and my mechanical knowledge or lack of it's going to come through right now, but suppose that we beef it up and now it can, instead of holding 1 ton, it holds 2 tons now. That increases the capacity of that asset. So that would also be capitalized. The cost of it would not be expensed. If the pickup truck was on books for 10,000 and this cost, this work cost 3,000, we'd add it in. So now we have a $13,000 pickup truck. So major repairs are actually going into property, plant, and equipment. They can be if they increase the life span or if they increase the capacity. This is
Question for you, Professor. All right, so let's pretend that a piece of equipment or a truck or is like 20 years old. Battery or the how do you say, the engine dies. You get a new engine, you get a new battery. Would that not improve the I guess the lifespan of it, because you're improving, because it's increased, it'll last longer, hopefully. That's one less issue with it.
Yeah. If you do that, it would increase the life of it, then you'd capitalize it. I don't know if I should go into the details of this, but I'll go ahead and do it. Generally, if it increases the lifespan, you decrease the accumulated depreciation. I'll give you an example here. I'll give you kind of because this is one of those things that they do talk about. So for instance, let's say that we have this. And it has a cost of, let's say 20,000. Oh, hold on. Yeah. All right. Let me do this here. Okay, so the book value of this truck would be, or the carry value, probably carry value is probably a better way to put it, or net value. Okay, so let's say that we have this $12,000. So this truck is worth $12,000. If we increase the lifespan at a cost of, I don't know, some number, $5,000. So we put a new engine in. It would look like this. We would decrease the accumulated depreciation by 5,000. So that'll be 3,000. And so the carry value would be 17,000. It's sort of like if it increases the lifespan. So if it increases the lifespan, it's sort of like you're turning back the clock. So it's sort of like you're turning back the clock. Okay, undo that accumulated depreciation. We're turning the clock back, and now we're going to get another 5 years, 10 years, whatever it is, out of this thing. So if it increases the lifespan, it kind of resets the clock. So we turn back time a little bit here. The asset itself has not increased in value or in the initial cost. It's just turned back time to to reflect that it's going to last last longer. Okay, so that would be if it increases the lifespan. Let's go to the second example. I had to put that in. Hold on, I didn't finish this one. If it increases the capacity, it will increase the cost of the asset. And I'll show you what that looks like. It's very similar, but it's okay. So here's the new engine one. Let me. New engine, we turn back the clock and say, okay, it's going to last longer now, and so we sort of like we are starting over. And however long it increases now the life to, that's what we're going to depreciate over. So if it increases the life to 8 more years, then we're going to appreciate this over 8 more years, whatever's left in it. Okay, number 2. Okay, so let's say that this let's see, let's get a number that's not up there. 6,000. Let's say you spend $6,000 to increase the capacity. We're going to leave the depreciation alone. What we're going to do is add it to the truck. It's now a bigger truck. And this will come out to whatever they go. What is that? 18,000? You may want to check my math on that one. But the
You're good.
okay. So it's sort of like now we have a bigger truck. We don't have a $20,000 truck. Now we've increased the capacity from, what I say, 1 ton to 2 tons. It's a bigger truck. So we're going to increase the actual cost of the asset to reflect that it's now a bigger truck. It can do more work or however they did it. And if it's a combination of those two, it'll be some kind of combination of the adding it to the value of the truck and increasing the lifespan. So it is possible that it hits both those. But anyway, that's why we look at these repairs, and we look at these repairs to see if if they're being reflected on property, plant, equipment. It can also be the other way. WorldCom, one of the biggest frauds in history, what they were doing is saying everything that should have been maintenance, they were putting it on the books as an asset. So instead of having $2 billion of expenses, they had $2 billion of brand new assets on the books, and there were no new expenses, and that was their fraud. Their fraud was that they capitalized everything. They capitalized, even routine maintenance of, their phone service. They count that as an asset. So it can go the other way too. But a lot in one of the reasons why we do it, especially there's a lot of not in accounting so much. There's a lot of times people don't realize, especially maintenance people, the accounting of it, and that it is possible that goes on as a new asset or it reduces the depreciation of it. So it's one of those things that's kind of common, especially if you're not, familiar with those kind of accounting rules. But yeah, so if it increases the capacity, it gets added to the asset. If it increases the lifespan, is sort of like we turn back the clock on this accumulated depreciation. Okay. Investigate the status of property, plant, and equipment not in current use. Uh, I'm pretty good. So only that stuff that's being used is going to be included in property, plant, and equipment. So if you have the property, plant, and equipment that is not being used, and it couldn't be not being used for any number of reasons. Maybe it's something that is old and you're trying to sell it, or you're gonna, sell it. You're not using it. So you go back to the pickup truck. The old pickup truck, they said, it'll cost too much to repair it. So, okay, well, we'll buy a new pickup truck. Well, that old pickup truck is no longer being used. You cannot have that property, plant, and equipment. I'm gonna sneeze here, so sorry about that. I didn't sneeze. Oh, I hate that. So property plant. So if it's not being used, it can't go in property, plant, equipment. The natural question after that is to say, well, where does it go? If it can't be in property, plant, equipment, where do you put it? And usually, if it's property that's not being used, usually land. Usually that will be carried in the investments category. It's the unused. So unused property will usually be in investments. Unused equipment other assets. Yeah, unused factory could also be, well, usually the factory would go along with the property. So I guess the factory could be either of those actually. Because it might be that you have a new factory that you're just not using yet. And it could also be that that you're waiting to get rid of it. One of the teachers used to work here, Dr. Wesel, yeah, we don't know he's a doctor. Weslowski. He worked for ComEd, and they had an audit, and there was they found a building. They found a building on one of their sites that they had no idea was there. The auditor comes back and says, "Well, what about this building?" And they look back, but they couldn't find where it was. It was some building that was built like in the 1930s or something. Big, huge brick building, but in a part of the land that they just never looked at. And an auditor, like driving around, found this building, and I asked them about it, and they said, "Well, we don't have it in our book." And so they they just had the building torn down because it was a hazard, but and weird things like that. Okay. Time is a little more than this than I thought. Okay, and we'll push on. We'll see if we can finish up some of these. Okay, so we're still on testing it. Okay, client's provision for depreciation. Depreciation is an allocation. And what we mean by that is depreciation, you're simply taking a cost of something and saying, okay, this is gonna last for 5 years. So we're gonna depreciate it over 5 years. We're gonna expense it over 5 years. Depreciation is just an allocation of the cost. It is not trying to find the value of it. So if you buy a drill press that's gonna last for 5 years and you pay $500 for it, you say, okay, every year we're gonna depreciate it by, say, $100. So $100, $100, $100. So we're gonna allocate the cost of that machine over 5 years. It's gonna last for 5 years. So it's an allocation. It's not trying to find the value of the drill press. The drill press might be more or less than that. Or, you know, I guess it's in the realm of possibilities. It might be exactly that, but that's not really the point of it. The point of it is to allocate it. Inventory is an allocation. Yeah, so there's a lot of things that are allocations, and allocations have 2 criteria in accounting. And they must be 1, systematic, and 2, rational. Now, we have different methods of depreciating things. We can do straight line. You guys probably have done all these, I'm sure. Production or activity method. There's a number of normal ways that they have doing these. So these are kind of the ones that they would normally have. But all of these, they must be systematic and rational. These are the 2 criteria. So, and just because we have these different methods doesn't mean that there aren't additional ways of doing it. You know, there are, and in other circumstances, you could use those. But so systematic and rational. Well, let's look at those. Systematic means that, well, if I say I have a system for doing something, what does that mean? I have a system for filing.
consistent way of doing it.
Yeah, it's gonna have a consistent way of doing it, and it's gonna have a way of doing it that, I can do it, it should come out with the same result as if you do it. It's repeatable with the same results. So whether I do it, and you do it, it doesn't matter. So repeatable with the same results. And what does rational mean? It means that what?
There's a reason for doing it and it makes sense.
Yeah.
It's
Yeah,
logical.
Well, they must be both of these. So it has to be repeatable, the same results, and it has to be rational, and it makes sense, it's logical. So suppose I do this, I go out on the factory floor and we have 3 different production lines, and I take the production manager from each one and I see how tall they are. And I use their height to depreciate the equipment. Is that systematic? I'm going to depreciate the stuff using their height. It actually is. Because someone else could go out there and do the same thing. They could measure, how tall are they, and then, figure out how, All right, so it's systematic. It doesn't make any sense. It's not rational. So it has to be both. It has to be systematic, that it's repeatable with the same results, but it also has to make sense. And if it meets those 2 criteria, it's fine. Okay, impairments. This is gonna be a little bit tricky. Impaired assets need to be reduced to their net realizable value. And this can be a real problem. It can be a real problem because a lot of times it's hard to tell if an asset is repaired. If you have, if you have 13 machines that do the work for whatever it's supposed to do, it's very hard to say how much value is added by this machine. How much value is added by this machine? And if they're not adding enough value, so for instance, if this machine costs $6,000, but it's really only doing $4,000 worth of value, it's impaired. But it's very hard a lot of times, to figure out, in a rational way, if any of these are repaired. So this is one of those things that in accounting is kind of it can be kind of a gray area, because a lot of times they're mixed together. And I've had engineers that tell me, well, if I don't know if that machine is impaired or not, but if we don't have it, we might as well just close the doors because we can't make trucks. So it's very difficult a lot of times if it's in, because everything is so interconnected, to know if any single machine is impaired. It's easier to see if something is impaired in total. So this assembly plant might be impaired if it's, the cost of running it is more than the revenue getting from it. And, it doesn't look like that's gonna change. So it is possible sometimes if you can get, isolate a large, the complete process and see if it's compared, but as far as the individual items, it's very difficult. Sometimes anyways. Okay. Let's stop here. Let's stop here and take a break. No, wait. Back at, let's say 7:10. Oops. Okay. Any questions on this? The impairments? Okay. All right. So I'll be back at 7:10. We'll say, and we will. We'll certainly finish this handout tonight. Okay. Do that. Okay, so, so retirements are actually a bigger, are usually trickier than additions. Additions, you have tons of paperwork, you know, purchase orders, internal documents, external documents, shipping documents, tons of stuff for additions. Retirements sometimes don't. Now, hopefully they have some, they have some kind of a form for retirements of equipment. That's ideally, that's what you'd have is a retirement um, uh, form that we filled out when you want to retire something on the plant. But you never know. And and people working in the plant, you got to realize they're not worrying too much about accounting. So a lot of times they get the new piece of equipment in, they put the old one out for the garbage, and that's it. Sometimes it's not even sold, or they don't think it's worth anything. And if accounting doesn't know, it might be that whatever that item is might be sitting on the books for years, even though it's been gone for years. So retirements are trickier. There's usually not a ton of paperwork. Now, if it has some kind of a value to it, you might try to sell it and get more and get some value from it. But a lot of times, there's less paperwork, and two, there's less interest in it. Okay, we got the new drill press in, and the old one is going out, and people don't really care too much about the old one. It's they're not going to use it anymore anyway. So a lot of times retirements are a little bit trickier than the additions to it. And so I know, when I was doing auditing, I would look at some of these. A few ways to find it. Here, let's pick this up. How about? So how do you find these? When a new item is purchased, a lot of times an old item will be retired. So. All right, so I'll think the way it is. Sometimes when you purchase a new piece of equipment, I mean the retirement of the old equipment. So you look at the additions, okay, we got a new drill press. Okay, well, check to see if it was replace an old drill press. Yeah, I think it did. You know, okay, well, let's find the old drill press, you know, and see what happened to it. So see, you know, if you don't have retirement for a drill press and they bought a new one, it could mean that it's gone and it should be taken off the books. So retirements, one of the ways you can look for it is to look at the new equipment that's purchased. Check the very old equipment that's still on the book. You know, very old equipment is on the books. It's, you know, very likely that it's not there. Usually equipment doesn't last for 30, 40 years. It's replacing stuff that's more efficient and computerized and whatever. So, you know, it's very possible if you have something on the books for you know, a long period of time that it may not actually be there at all. There's an exception when I was at, there's an assembly plant we had in, I think it's still there. It was Navistar at Springfield, Ohio, that we had these giant motors that were made in 1928. They're huge. They're the size of this room, and they're carrying them on the books. I forget, there's some crazy amount of money, $1 million each or something like that. But anyway, they're made in 1928, and they just keep rebuilding them. You know, because they're these big heavy things, and I guess it takes like 2 years to rebuild one of these things, but they still use them. So you know, 1928, you say, okay, there's no way that's going to be there, but you know, it was. So, you know, checking on the books for very old equipment. These are probably the two of the best ways to do it. And you can also, you know, let me write this in. So book to floor test, and this kind of goes along with these other ones too, and that you say, okay, you get a list of items that are on the books. You know, you might pick stuff that's a little bit older, but you probably take a listing, you know, a random listing of a number of them, and just go find them on the floor. So you get 15 numbers, tag numbers. You go on the floor and try to find those tag numbers, and if you can't find them, you ask somebody to help you find them, and you know, they should be able to have it. And if you can't find them anywhere, it's probably that they're gone. So book to floor is also how you find for things that have been retired that are not actually on the books. And again, those other, it's not that these are mutually exclusive. These might aim you in the direction of which ones you want to test. You know, a new piece of equipment comes in, let's look for, you know, the old drill press that's on the books, see if we can find that one. Or very old equipment. Okay, we got this equipment that's 36 years old. Let's go find it. Okay. Book to floor test, you look at the stuff on the books and then you go to the floor and find it. Okay. Now, just because you find something doesn't necessarily mean that you own it. So one of the things you look for is the actual ownership of it. Did you pay for the receipts and all that sort of thing? Because it could be there's a new piece of equipment on the floor and it's actually not owned. It could be purchased and then sold and leased back. That's a kind of common thing that they used to. It's probably not as done as much anymore, but that used to be very common. Where you actually buy the piece of equipment. There are companies out there that will buy your equipment and then lease it back to you. And for them, it's just a financial arrangement. Okay, so property plant. He has an O in it. The property and plant, that's land and building. That is going to be usually a deed. So property and plant, or land and building, those are going to be deeds usually. So that'll show. Most deeds are, here's the land. Oh, and by the way, there might be something on it. If there's a house on it, okay, that's fine. There's a house on it. But you generally buy the land and the house goes with it. So anything on the land goes with it. It is possible to separate them. You can't legally separate them. I know that we were looking to rent a building back when I worked for Robert Morris. We were looking to rent a building. We found a building to rent. The people, one group owned the building and the other group owned the land underneath. And the people that owned the land underneath, we couldn't get a rental agreement with them. So, if you wanted to use the building, you had to get a lease from the landowners and the building owners, who were two different people. So anyway, that's so a lot of times deeds will be that you buy this land and whatever's on it is yours too. So it'll prove both of them, the land and the plant, property and plant, land and building are owned. Okay. Temporary leaseback arrangements. Scan the cash disbursements for payments to lease companies. Because it is possible that while they purchased it, they bought it, they have all the documentation, that they no longer own it. It's possible that somebody else owns it. Okay, some of the rental stuff, and actually this kind of goes with this too, but I just talked about this one. That's up here. Copy this. Okay, perform analytical procedures or data analytics for property, plant, and equipment. And this is basically ratios. Could be sales over, say, average assets. So, you know, when we talk about, there could be a number of these things you do, and you look for reasonableness. You remember the analytical procedures. You're looking for plausible relationships. Okay. Lease agreements. They could come in two different flavors. It could be that you are leasing, that the client is leasing the equipment from somebody else. So somebody else owns the equipment, they're leasing it from them. By the way, this is one of the reasons why you have airlines that don't have any airplanes. They'll order the airplanes will come in and they'll immediately sell them to a financing company. So the financing company owns the airplanes and lease payments are made to, you know, whoever, whatever the financing company was that bought the airplanes. These are very common. They've tried to tighten the rules up quite a bit on those recently. That if they're more than a year, they have to be disclosed and they have to be put on the books for capitalized loans. Do you guys know about off balance sheet financing and capitalization and all that? Because that's a big one here. Maybe I should go into that. Yeah, so the accounting rules. These are fairly new. Say within the last 2 years. Any lease for more than 12 months must be capitalized. And it comes down to, you know, what they used to call off balance sheet financing. So let's say that we purchase a truck on credit, $20,000. So you have an asset of $20,000 and you have a liability for $20,000. Now, here's the thing about this example. From the company's point of view, they certainly don't want the liability on the books. It makes them look, it makes their financial position look worse. But they really don't want the truck on the books either. If you have a bunch of assets and your income might be lower compared to your bunch of assets, you might look very inefficient. So not only don't they want the liability, they don't want the asset on the books either. So in the past, what they would do is instead of buying a truck, they would say, okay, we're going to lease it for exactly the same as money that we would pay if we went and got a loan and purchased the truck. We'll lease it instead of buying it. And that's called off-balance sheet financing. It keeps the truck off the books and it keeps the loan off the books. Okay, so the new rules are, if the lease is for more than 12 months, it has to be capitalized. In other words, you're going to put something on the books for that purchase of it, whatever it is. This pretty much eliminates that off-balance sheet financing. You can still get leases, and there's still a reason why you get a lease, but the avoiding of trying to avoid getting things put on your books is pretty much eliminated. I'll tell you a funny story. One of the guys, actually my first roommate after I graduated, he worked at a CPA firm with his brother. There was only like, I don't know, 5 or 6, I don't know how many people were in there. But anyway, their whole, like 90% of their practice was going around the country making lease agreements that would pass the muster so that the companies didn't have to put assets on their books. It was all about off-balance sheet financing. So anyway, then the new rules are that if you sign a lease for more than a year, that you're going to put that actually on the books. You're going to capitalize it. And if you think about it, let's say you sign a 5-year lease. Well, there's no difference between signing a 5-year lease and signing a 5-year note. It's a liability. It's a promise to pay over a period of time. So getting those liabilities on the books and the capitalizing the asset is part of the new rules. So if this was leased instead, well, what they've leased for 5 years, it would look like this. Leased asset, it may go a little bit and tell more what it is, but it would still be on the books. They say, okay, we don't own it, we're just leasing it. Okay, you don't do that. And you don't do that. And over here, lease obligation or lease payable, either one, for 20,000. Oh, that's not right. Yeah. Okay, so if you lease it, if it's for more than a year, you're going to pick up a leased asset and a lease obligation. And like any lease obligation, any kind of a long-term liability, there's gonna be interest on it. Okay, so, and again, these could go either way. This could be that, hey, we are leasing this from somebody else. If it's for more than a year, we bought it. Or it could be that we are leasing an asset to somebody else. If it's for more than a year, they bought it. So, notice that there's this kind of dynamic about leases. Okay. And leasehold, let's just turn down to leasehold improvements. Because these are actually a problem area. You know what, I'm gonna do this on a piece of paper. Hello. We're gonna do this on the can. Okay. Okay, so let's say you lease a building, it's got land, here's the building. And so you lease this building, and let's say that you want to get customers to show up at your, so you attach a sign to it. That sign is an attachment. It's a legal term that if something is attached to a building. No, I don't want this. Sorry about that. If something is attached to a building, whatever's attached to the building, it's the property of the owner of the building. So if we're leasing this building, we put up a sign that says "Eat here." That sign, the minute we attach it to the building, belongs to whoever owns that building. It's an attachment. Now, we didn't put that sign up for no reason. We want, to advertise the building or whatever. But anyway, that's a leasehold improvement. And when you put this on the books, so this is a leasehold. I keep doing that. So used to. So this is a leasehold improvement. So we've improved our lease by putting the sign up. Okay, let's say that the sign's life, is 12 years. And the lease is for 5 years. What do we depreciate it over? Do we depreciate it over 12 years or 5 years? So the sign has a life of 12 years, the lease is for 5 years. How much
Would be the lease?
Exactly, the shorter of the two. So whichever is shorter, the life or the lease. So that sign is a 12-year life. Remember, we don't own the sign. Legally, it's actually an intangible to us, because whoever owns the building owns the tangible, lease, the sign, I should say, the leasehold improvement. So you depreciate it over the life of the lease. And the only way around that is if they have a contract that allows them to renew the lease going further in the future, but it has to be in writing that they can do it, and they have to have the ability to sign that lease again, whatever it is. A few years ago, there was a big crisis because a lot of these, it is happening in real estate, that a lot of there's a lot of flux in the real estate market, and that companies were not renewing leases. So someone come in and sign a 3-year lease for a whatever, I don't know, Arby's. So someone come in and sign a 3-year lease to put a, have an Arby's, and people at Arby's, they say, okay, we're going to keep releasing this place, and they say, no, at the end of the lease, you're out. So all this stuff that they thought was going to last for 15 years, all of a sudden it's a big write-off. And so that's what was happening. So now the new rules are that it has to be in writing, or else whatever the shortest term of the lease is what you're going to be using. And that's why as auditors, the new rule, it really affects us, because now we have to check to see the lease, unless they have an ironclad lease that they can extend it. They're not. Now, the weird thing about leasehold improvements are that they're intangibles. But are usually because they're usually attached, they're usually thought of as kind of the property, plant, and equipment mode. We do have a category for intangibles, patents, copyrights, all that kind of stuff. And even though these are really intangibles, because it's usually the benefit of the sign, not that we own the sign, but that it's one of those weird things. Is an intangible to us, to whoever's is put the sign up, but is usually put in the books for property, plant, equipment. Look up a restaurant chain, and you will see millions and billions of dollars tied up in these leasehold improvements. These are serious numbers. And so, that's why the auditing is, hey, we got to look at all these leases and see what, what are they doing with these? How much are they advertising it over? Okay, basic depreciation, we kind of talked about that. Oh, these are footnotes, I'm sorry. Yeah, in the footnotes, you'd have to have the basis for depreciation. We already kind of talked about that a little bit. Here, the method of depreciation must be explained. One of the things a lot of times that you'll see in the depreciation, is for depreciation, including, the method must be explained. But a lot of times they'll have conventions. A very popular one is half-year convention. And the half-year convention is that for new additions, okay, new additions that are purchased throughout the year. Okay, so we have some were purchased in January, February, December, March, April, May, whatever, all the way through to December. That on average, So some of these things will be depreciated over 12 months. And some will be depreciated over 0 months. For instance, at the end of December, we round off the nearest month. So if you buy something on December 20th, you're not going to have any depreciation for that. So for any given item, the depreciation is between 0 and 12 months. So what they do a lot of times, they'll say, okay, by convention, everything that we buy, all the additions, we'll say that they're all were bought halfway through the year, and on average, it'll come out exactly the same. So the half-year convention is used often is that we buy some things in January, we buy some things in December. On average, for all the purchases, it'll be about 6 months, so a half a year. So we'll take a half year depreciation the first year, and then a full year the next year. And go on. So a lot of times those conventions that are in there, especially for things that have a large amount of purchases, UPS trucks. I don't know how many UPS trucks they buy a year, but it's a lot, I'm sure. So I would be surprised if they didn't use a half-year convention. Okay, we buy some in January, we buy some in December, and all the other months in between. So on average, half a year. So that's one of those things that there's nothing wrong with doing it, and it's systematic and it makes sense, but you have to disclose it. Yeah, so that's what you'll see that also included in the basis of depreciation a lot of times. The notes must indicate precisely you have assets budget collateral for must be disclosed. And we talked about this earlier, property, plant, equipment not being used. This will usually be also in the notes as okay. You know what? I think I'm going to make an executive decision here. Take out chapter 16. Okay, so here's what's going to happen next. So I'm going to put the 2 handouts we did today. We finished up the inventory, chapter 12, chapter 13, property, plant, and equipment. I'm going to eliminate chapter 16. And so what I'm going to do is I'll put a test together and I'll send it out probably tomorrow, to be honest with you. So tomorrow you should be getting a test on chapter 16. No, the test on not 16, but on 11, 12, and 13. And that'll be due by the last day of class. So let's write all this down. So I'm taking this out. Okay. And it will be due. Well, since the last thing, it'll be due on May 2nd. They'll be emailed on Friday 4-22. And that'll be the last exam for the class. So it'll be emailed by tomorrow. We'll be doing Monday 5-2. Next week's class will be optional. And it'll be there. If you have any questions on the exam I'm going to send out tomorrow, or anything else for the semester, you know, feel free to ask. But I think we'll use that the time next week as a kind of a cleanup for it. So anyway, so I'll send out the test. Will be on chapters 11, 12, and 13. And then if you next week's class will be optional. If you have any questions on anything, you want to go over something, if you're missing something and you want to, you know, go over it, we can do it at that time too. Okay, any questions? Okay, well, I will be sending out the exam tomorrow. If I get it done earlier, I'll send it out earlier, but let's shoot for tomorrow. And it'll be due the last day of class, which is Monday, May 2nd. Okay, well, have a good evening.
Thank you, Professor.
Make good.